Welcome to Deloitte's Debriefs Tax webcast series in Asia Pacific. Our webcast today is from our corporate income tax series and is titled M&A and Carve-Out Strategy in Australia and New Zealand. My name is James Deutsch and I'm a tax director based in Deloitte, Australia. I have the pleasure of hosting today's webcast. I have two speakers with me today, Aaron Black and Ian Fay. Aaron is a Deloitte advisory partner and the leader of the Deloitte Private Equity Group from Deloitte, Australia. Ian is a tax partner from Deloitte, New Zealand. You may access our bios on the left side of the screen. Before I introduce the agenda for today's webcast, I'd like to take a moment to highlight some of the features of a webcast console. First, all users are on listen-only mode. If you have any content-related questions, you can submit at any time in the Q&A box at the bottom right of the screen. We'll do our best to respond to your questions during the presentation. Second, all PC users can maximise or minimise each box at your convenience during the webcast. You may also explore the icons at the bottom of the screen. If you want to download today's slides and related publications, please go to the Downloads and Links box. On the other hand, mobile device users can view the slides and answer the survey on screen. Thirdly, if you require an attendance record for this event, you can download your CPE certificate by clicking the Request CPE icon at the bottom of the webcast console. Next slide, please. So the agenda for today will begin with a market overview highlighting key trends and notable recent carve-outs and demergers in Australia and New Zealand. Next, we have an overview of the commercial considerations when thinking about a carve-out or demerger. Then we'll talk to an overview of the key Australian and New Zealand tax considerations, and we'll finish with questions and answers. Aaron, I'll now hand over to you to begin.
Thanks, James, and great to be speaking. Everyone, you can see there on the slide on the bottom left there that activity remains very strong in terms of demergers. What we've shown on this page is demerger activity, not carve-out activity, but equally carve-out activity is also very strong in the Australian market. You can certainly see there that some very large and notable deals have made big differences to the the value of deals, but the real key trend has been a real pattern over the last number of years of a large number of demergers in the Australian market. Driven by a number of factors, certainly the investment community continues to really look to companies to be maximising their returns. And as we'll touch on in a few pages, certainly demergers have shown to, in almost or in many cases, to really be a positive from a share price performance. Certainly, again, the last couple of years, some 10 demergers and again, of a large value. So it's probably the most striking part on that chart on the bottom left, where if you look at that last bar column, certainly by number, if not by value, record levels of activity over the last couple of years. And in terms of the dialogue we're having with boards at the moment, it certainly is continuing to be a theme that will be looked at with a lot of focus for the next couple of years. Next page, please. Shown on this page, both for Australia and New Zealand, just some of the more notable transactions that have occurred in the market. And certainly one of the thematics that you'll see through here is and almost always for demergers, about selling non-core or assets that aren't being fully valued in terms of in the parent company. So Wesfarmers divesting Coles is probably the most obvious example. Wesfarmers obviously a well-regarded conglomerate in this market, but its decision to sell Coles, which for anyone outside of Australia is one of our two largest supermarket and liquor businesses, putting that into a separate entity has resulted in very strong share price performance for both companies post. So a conglomerate, Coles, obviously quite different in terms of their businesses, but the freeing up of the businesses from a focus perspective and then just the additional focus that they've had from shareholders has certainly assisted. One of the other things we're certainly seeing at the moment is quite a lot of activity around demergers and carve-outs due to ESG considerations. Most notably of late, AGL looking to divest or separate their assets into a group that isn't as exposed to ESG concerns as the other group. And that then allows investors to make very clear decisions as to which group that they're investing in. Equally, New Zealand, not as many deals as in Australia, but again, continues to be something that's being very closely looked at by companies. Onto the next section, please. So a number of considerations that are often made when people look at whether to undertake demergers. And it's really that the AFR did certainly highlight it in terms of that first comment in the top left there, where it really is about unlocking trapped value. When institutional investors look at companies, they tend to do it with a certain lens, and there's just parts of the company that aren't fully valued and focused on as a result. And demergers really do allow that to be unlocked. Also, there's various benefits around management being incentivised, around employee retention, and I've already touched upon ESG considerations. So certainly from an equity market perspective, continues to be a lot of focus on companies really maximising shareholder value by separating those parts out that make sense. On the carve-out side as well, certainly with the amount of private equity in the country at the moment, so multinationals are regularly considering divesting and carving out their non-core Australian operations. We've seen multinationals consider selling their Australian businesses in their entirety and New Zealand businesses in their entirety to free up capital for other geographies. And just given the volume of private equity that's available, we continue to expect that there'll be a number of transactions of that nature in this market as well. So all in all, we're certainly expecting there to be continued focus on carve-outs and demergers and quite strong activity in the years to come. James, hand back to you.
Thanks, Aaron. Slide, please. So turning now to the tax considerations and key questions when contemplating a carve-out. The first one, which is probably the most obvious, but is what is being carved out? Is it shares or assets? And this will obviously have a significant impact on the transaction structure and the tax implications, including possible taxable gains and exposures to historical tax liabilities. Will the sale be of a majority or minority stake? And what impact will that have on the acquisition structure? In Australia, it can be possible to reset the underlying tax cost base of assets to their market value where an entity joins a consolidated group, which requires an acquisition of all of the shares. This can be particularly beneficial where there is significant value in tax-preferred assets, for example, inventory and software, which will lead to a high depreciation deductions following acquisition. If only a minority stake is being sold, though, this may limit upside for the purchaser. And what is the preferred structure for the acquirer or the investors? If assets are being packaged up for sale, this can be an important consideration. For example, whether the assets are transferred into a company or a flow-through vehicle like a trust. Is there any restructuring required prior to carve-out, i.e. to consolidate assets or business units into one or more legal entities or a newly incorporated clean entity? As I'll touch on shortly, it will be important to think through any tax leakage on the transfer, as well as any historical tax liabilities or exposures that may be inherited by the purchaser. A newly incorporated clean entity may be preferred for this reason. Will there be any income tax leakage on the share sale? And this will depend on what is being sold and the cost base and proceeds received, as well as the availability of any losses, either current year or carried forward, to offset the taxable gain. And what about tax leakage on the distribution of proceeds to shareholders? This will depend on how proceeds are returned, including whether by way of return of capital or franked dividend, i.e. dividend paid out of tax profits, or an unfranked dividend. Demerger relief may also be applicable. And what about other non-income tax leakage? For example, stamp duty or transfer duty, goods and services tax, and employment taxes. Also, are there any tax groupings to consider? This may be relevant both to understand any historical exposures that a buyer may inherit outside the entity being acquired, i.e. exposure to secondary tax liabilities, but also any mechanical steps that would need to be documented in the sale agreement. And what about tax attributes, for example, losses? The impact of the transaction on the carried forward loss position of the entity being sold should be considered. If it is leaving a consolidated group, any losses will remain behind. Alternatively, any losses may be forfeited on change of control, i.e. more than 50%, unless the business continuity test can be satisfied. And how are any historical tax liabilities or exposures to be dealt with? What contractual protection will be provided, for example, in the form of tax indemnities and warranties? This will largely depend on the acquisition structure, including the ownership interest that we retain by the seller, as well as any tax groupings as mentioned. For an asset sale, though, any historical liability should remain with the seller, although it will be important to consider any historical positions in relation to transferred employees or contractors that may need to be considered going forward, including the correct classification of contractors and any employment tax obligations. And lastly, what about the operational stand-up tax function requirements of the business going forward? This may also need to be factored into any transitional services agreement and post-acquisition planning. And so a number of these questions are the same for both Australia and New Zealand. Some of them are less relevant or not relevant at all, given the difference in tax regimes, which Ian will touch on later. In particular, New Zealand does not impose stamp duty, nor does it tax capital gains. Next slide, please. That brings us to the first polling question of the day. And the question is, how likely is your business to undertake a carve-out in the next 12 months? And your options are very unlikely, unlikely, likely, very likely, or don't know or not applicable. While waiting for the results to come in, it's interesting to note that according to a Deloitte survey of heads of M&A in early 2020, 54% of respondents expect the number of deals they pursue to increase in 2020, despite the expected negative effect that COVID-19 would have, with 58% of respondents expecting it to negatively impact. Certainly the tail end of 2020 and 2021 were very strong in terms of deal activity. Aaron, you touched on it a bit earlier, but how did you see the market play out last year, probably in terms of M&A more generally?
Yeah, it was rather extraordinary last year. Certainly at times during 2020, it felt like the world was going to be quite a difficult place from a transaction perspective, but certainly in Australia and New Zealand, last year was a record year. Deal value of some 130 billion last year versus 40 in 2017, 49 in 2018, and 24 in 2018 and 24 in 2019. So rather quite extraordinary given the backdrop, and the expectations are that we'll continue to see a buoyant market from an M&A activity this year as well. Not as strong as last year, probably moderating more back towards historic levels, but certainly a good year nevertheless.
Thanks, Aaron. It's an interesting mix there in terms of responses, relatively even spread, with the exception of very likely. Next slide, please. So as touched on earlier, while an asset deal is generally more straightforward than a share deal, at least from a tax perspective, there are still a number of important considerations to think through, including any tax costs or leakage associated with the carve-out. Where assets may need to be transferred internally before the sale, an asset sale may be simpler and more efficient, as only those assets that are being disposed of may need to be transferred, with the balance of the assets remaining. And while any transfers may be manageable where the entities are consolidated, which broadly requires them to be wholly owned by the same Australian holding company, on the basis that the entities are effectively treated as a single entity for tax purposes, and any transfers are ignored, it will still be important to consider any stamp duty on the transfer, unless reconstruction relief is available. The taxable gain or loss on the transfer of the assets will depend on the tax cost base of the assets, i.e. what you paid for the asset, plus any incidental costs, and generally the amount you receive for it. Separate valuations may be required if the assets are being transferred as part of the business. Also, if the parties are not dealing at arm's length, for example, they're related parties under common ownership, then there may be deemed market value proceeds received. Any taxable gain may then be offset by any current year or carried forward losses. It's worth noting that a buyer and a seller may have different views on the value of certain assets, and for this reason, the sale agreement may typically be silent on the allocation of value and leave it open to the parties to take their own view. Interestingly, this is to be contrasted with the position in New Zealand, for which there was a legislative change that took effect from 1 July 2021 that effectively requires the parties to agree an allocation. Ian will talk to this in further detail later. On a direct transfer, it will also be important to consider GST. Where discrete assets are being transferred, not an entire business or going concern, the transfer will be subject to GST. While this should generally be a timing issue only, the GST is paid and then recovered in the next month or quarter, there will be a permanent cost if the transfer is subject to stamp duty. The stamp duty is calculated on the GST inclusive purchase price. Broadly, in order to qualify for GST-free going concern treatment, it is necessary to transfer everything that is required in order for the business to continue to be carried on. Stamp duty implications on an asset transfer will vary across the different states and territories in Australia. Broadly, transfers of land and land assets will be subject to stamp duty, as will the transfer of intellectual property, goodwill and receivables in certain states. Further complexity can arise where the business operates in multiple states, in which case the value of intangible assets or goodwill may need to be apportioned across the various states and territories. Next slide, please. And consider now the direct disposal by the Australian headco of the shares in Australian subco. Where headco disposes of subco, any gain, i.e. proceeds less cost base, will generally be taxable to headco. And unlike an asset sale, any historical tax liabilities will typically be inherited with subco, although it may be possible to obtain clear exit from the consolidated group, which can mitigate historical tax exposures. And I'll touch on that further shortly. Similar to an asset sale, though, it may be possible to reset the underlying tax cost base of the assets going forward, which will determine the tax depreciation positions or tax shelter going forward. However, this will only be possible where the new entity acquires 100% of subco. Further, where headco is to retain a significant interest in subco after the sale and rollover relief is obtained, any consolidation outcomes may be limited. Effectively, only the market value of the buyer's interest will be taken into account in setting the value of the underlying assets, with the balance limited to the historical cost base of headco, which may be nominal. It will also be important to consider any stamp duty implications for the buyer, i.e. landholder duty, where land and other land assets in states and or territories exceed the relevant thresholds. As mentioned earlier, there may also be stamp duty costs in connection with any restructuring required prior to sale, i.e. to consolidate assets or business units into subco. And this may give rise to double duty, once on the restructure by the seller and again on the acquisition by the purchaser. And while relief is available in certain circumstances, this is typically only where there is a restructure that does not change the overall economic ownership, i.e. the corporate group remains intact. Next slide, please. From an Australian perspective, there can be further complexity where the entities are grouped for Australian tax purposes. Broadly, where headco wholly owns one or more Australian subsidiaries, i.e. subco and other subcos, it can elect to form a consolidated group, following which headco and subco and any other wholly owned entities will be treated as a single entity. Where subco subsequently leaves the headco consolidated group, i.e. on a sale, subco can be jointly and severally liable for the income tax liabilities of the headco income tax consolidated group, i.e. in the event that headco, as the head company, fails to pay a group liability by the due time. However, it can be possible to limit joint and several liability where subco obtains clear exit from the headco income tax consolidated group. This requires there to be a valid tax sharing agreement in place for the group and for subco to pay a reasonable estimate of its share of the income tax liability of the headco income tax consolidated group for the period up to its exit, including factoring in any risk of an amended assessment. Therefore, it will be important to consider the above as part of any tax due diligence to appropriately manage the position as part of the carve-out. There can also be a capital gain arising to headco where the exiting subsidiary is in a negative asset position, which can be an important point to manage in the lead up to an exit, for example, by rationalising intragroup liabilities. Any tax attributes, for example, tax losses or franking credits, remain with headco. There may be similar issues to consider for GST in terms of grouping and also payroll tax. And while GST can be managed via a similar clear exit mechanism, payroll tax may be more difficult, and instead the purchaser would have to rely on contractual protection to limit inheriting any joint and several liability for payroll tax liabilities of a broader group of entities, i.e. even entities that are entirely separate businesses but are under common ownership. Next slide, please. Where headco disposes of a foreign company, the outcomes may be different. Where certain requirements are satisfied, capital gains or losses on the disposal of shares in a foreign, non-Australian company may be reduced by a percentage that reflects the degree to which the assets of the foreign company are used in an active business, possibly to zero. This is referred to as the active foreign business asset percentage. Broadly, the key requirements are that Headco holds at least 10% of the direct voting rights in the foreign company for a period of at least 12 months, beginning no more than 24 months before the time of disposal. Active assets include assets that are used or held ready for use by the company in the course of carrying on a business, goodwill, and shares, other than shares in an Australian company. Cash or cash equivalents are a common example of non-active or passive assets. Depending on whether the disposal is taxable to Headco or not, it may impact on the options to return the proceeds to shareholders, for example, in the form of franked dividends paid out of after-tax profits. Next slide, please. In order to return proceeds to its shareholders, companies may choose to pay a dividend, undertake an off-market buyback or capital return, or undertake an on-market buyback. Whether buyback or capital return is undertaken off-market, it will be important to consider the capital and dividend split of any buyback, as this can significantly alter the outcomes for shareholders. Typically, it's common to seek a ruling from the ATO prior to undertaking such a transaction to agree the appropriate split and avoid the application of the specific anti-avoidance rules. To the extent of the capital return, there may be no upfront tax implications for shareholders, but rather the distribution will reduce the cost base and result in a higher future taxable gain. Where the dividend is franked, Australian tax resident shareholders can get a credit or offset reflecting the tax already paid by Headco, and the Australian tax resident shareholders should be exempt. Non-Australian tax resident shareholders should be exempt from withholding. However, it may not be possible to frank the distribution when no tax is paid by Headco on the disposal. For example, where it is in losses, or the participation exemption applies as mentioned previously. It will therefore be important to consider tax implications or tax leakage on repatriation of any proceeds to shareholders. Alternatively, where listed, the company can undertake an on-market buyback. Next slide, please. One other option to return value to shareholders without undertaking a sale to a third party is to essentially transfer the underlying business directly to the shareholders. The shareholders acquired direct ownership over an entity referred to as demerged co that they previously owned indirectly via Headco. Broadly, where the reorganisation qualifies for demerger relief, there will be no taxing event for either the shareholders or the Headco. The policy rationale behind the relief is that when an entity undertakes a reorganisation of its operations, leaving members in the same economic position as they were immediately before the reorganisation, there should be no taxing event. The key requirement is identifying the restructuring of the demerger group, which is not a defined term for tax purposes. The restructuring then needs to satisfy a number of requirements in order to be a qualifying demerger for tax purposes. In particular, Headco must cease to hold at least 80% of demerged co. Shareholders must acquire the shares in demerged co and nothing else, for example, cash, and shareholders must maintain the same proportionate interest. And so where demerger relief is available, Headco will disregard the capital gain or loss from the transfer of the shares in demerged co, but will still need to manage exit liabilities, which can arise where demerged co is in a net liability position. And shareholders disregard the tax consequences of receipt of the shares, so no taxable dividend or capital return and no withholding tax. And they'll then also need to split their cost base in Headco demerged co shares based on the relevant relative market values. Of particular relevance currently is the nothing else test following some recent rulings by the ATO. The requirement that nothing else other than the shares in demerged co is acquired by the shareholders. Historically, prior to 2018, the ATO approved demergers that have been immediately preceded and or proceeded by a pre-arranged transaction with a narrow view of what constituted a restructuring. Broadly, anything in the assembly stage or post-demerger activities such as capital raising or divestments did not form part of the restructuring, and this therefore made the requirements more readily able to be satisfied, i.e. the restructuring was limited to the distribution to shareholders. However, the ATO has recently taken a wider interpretation
Well, it seems like we've lost James for a second there, so I'll try and step in and exercise a little my rather limited knowledge of Australian tax just to cover off the remaining comments he was about to make on the demerger slide. The point he was getting to is that where the sales conditional on a demerger occurring, then post-separation capital arising for the third-party acquirer of a 50% demerged entity, which is secured pre-demerger or listing, means that the demerger relief may not be available. Hopefully I've got that explanation right. What we might do, and sorry, I seem to have skipped forward now on the slides to the New Zealand section. Perhaps we'll come back to the polling question at the end then. All right. Moving to the New Zealand slides. What I'm trying to do here is look at the very similar set of circumstances that James looked at, but bring a New Zealand lens to bear to sort of give you a bit of a contrast between how the rules might work in New Zealand versus how James has talked through their work in Australia. So to kick things off, we'll look at what happens if we are looking at a sale of a business or a group of assets as part of a carve-out or a demerger. And this is, as James has mentioned, brings to fore the key feature of New Zealand tax regime, is which you don't have a general or comprehensive capital gains tax. Now that can sound quite exciting for non-residents, particularly looking at New Zealand as a market. But what you need to understand is that when we draw a line between what we think is a capital gain versus what we think is an income gain, we tend to draw that line considerably more towards income than capital. So a lot of transactions that in a traditional international context you might think of resulting in a capital gain, in a New Zealand context results in being treated as income and therefore taxable. So when we're working through assets, what we have to do is broadly divide assets into two classes. Either they're a personal property asset or they're a land asset, or real property asset. And in this context, land includes anything that's attached to land, the obvious one being buildings. And then we have two broad sets of rules. One set of rules applies to those personal property assets and the things like plant, machinery, software, etc. And the other set of rules, which are a lot tighter, apply to land-based assets. So when we're dealing with personal property assets, what we end up is we have three broad tests under which proceeds from disposal of a personal property asset can be taxable. The one that crops up and we think about most often, particularly in this context of a carve-out type scenario, is where the asset was originally acquired for the dominant purpose of disposal. And we need to think, so what does that rule mean? Well, that rule is tested when the asset is acquired. So when you acquired the asset, or did you have a dominant purpose of disposal? Now that purpose you use the asset for can change over time and ultimately lead to a decision to dispose of the asset. You need to go back to that original acquisition point to test what was the purpose of acquiring the asset at that time. And what can become really important is keeping really good records to support the investment decision at the time the asset was acquired. Often putting up a counterfactual type argument as to demonstrating why the investment decision related to something other than the purpose of disposal, with the obvious one typically being demonstrating a purpose of generating income. There's a couple of other situations which can catch and treat disposal proceeds of personal property assets as taxable. That's if the asset's held as part of a business of dealing in assets of that kind. So typically we don't see that crop up in this scenario, but it can do. And the other is a slightly difficult to understand concept of the asset was acquired as part of a profit-making scheme. So there we're looking at a set of circumstances and see whether there was ultimately a scheme in place that was intended to make a profit, and as part of that profit involves the disposal of the asset. As I say, when we then turn our mind to land assets or buildings, the rules are much, much tighter. And here we move from this concept of a dominant purpose of disposal to an acquisition for a purpose of disposal or with the intention of sale. So it's no longer a dominant test, and it brings in an interesting sort of technical debate in New Zealand of what's the difference between a purpose and an intention. But in keeping it simple, that lowers the bar considerably. So there's a lot more situations where we see land-based assets being disposed of where the proceeds are taxable, or certainly there's a high risk that they will be taxable. And then on top of those rules, we have what we refer to as tainting rules, where depending on the activity that the group carries on, there is a prospect for land assets to be tainted by being associated with another party that carries on a business of dealing in land or building or developing land. And if any of those features are present, then it doesn't matter if the land being disposed of is part of that business. As soon as you're associated with someone carrying on that kind of business, the disposal of the land is taxable. And then most recently, we've got a whole bunch of extra rules relating to residential property, but that's a lot less common in the context we're talking about today. Of course, can't forget if we're dealing with disposal of depreciable property, then we have the risk of clawback of depreciation or depreciation recovery income where the proceeds exceed the current tax book value of those assets. And we have another class of asset we refer to as financial arrangements, which in broad terms typically relates to things like loans and derivatives. And disposals of those types of assets and liabilities, they're always taxable, and it's a wash-up calculation that brings into tax anything that hasn't previously taxed through the course of ownership of that arrangement. But of course, in an asset deal, the flip side to the vendor having taxable proceeds in some cases on the disposal is that the purchaser gets to rebase those assets, and they get whatever they paid for those assets as the tax base going forward. So future gains calculated with reference to what they paid. As James mentioned in his segment, going back to July last year, we had a new suite of rules come in that now effectively forces the vendors and purchasers in an asset transaction to agree the purchase price allocation as part of the sale and purchase agreement process. And then the tax rules require that both the vendor and the purchaser then follow that purchase price allocation for their tax purposes. Now, there's still opportunities in the world of a no capital gains tax regime to get an arbitrage where the vendor has a capital gain, but the purchaser then has a step up to a depreciable or deductible asset. But they're a lot more limited, and the situations we saw a lot of previously where vendors would allocate proceeds to capital assets and capital gains, and purchasers would allocate purchase price to depreciable assets, and therefore you'd get a vendor taking a view there was no taxable income on disposal and the purchaser taking a view that there's significant depreciation deductions going forward. That has been effectively prevented under these rules. Now, I should mention if tax rules can't impose an obligation on people to agree a purchase price allocation, but they are quite persuasive because if parties don't agree, then the vendor gets to hold the pen and nominate the purchase price allocation. But if the vendor slips up and doesn't nominate the purchase price allocation, the right then flips over to the purchaser and they get a go. And if they also don't get around to it, then last resort inland revenue gets to specify the allocation for both parties. Right. Just quickly then touching on GST. New Zealand has a concept of compulsory zero rating for GST purposes where the transaction includes land or an interest in land. But in most cases, there are some exceptions to that. So that doesn't give people a choice. You have to have 0% GST on the transaction. If the transaction doesn't include an interest in that land or an interest in land, then if the transaction of the bundle of assets represents a business that is a going concern, then the parties can also zero rate the transaction. If neither of those circumstances apply, then the transaction is subject to GST, but that's typically more of a cash flow disadvantage rather than a transaction cost. But the good news in New Zealand is we don't have any stamp duty or other transfer taxes. So once we've dealt with income tax and GST, that's pretty much the extent of it in this context. Right, if we can move to the next slide, please. But often what we're seeing in a carve-out or demerger scenario is actually it's a subsidiary entity that is the object of the disposal. So we still need to turn our minds to the the capital gains tax consequences, because of course the shares in the subsidiary company are themselves personal property. So we're dealing with the same concept of, is the disposal of shares in a subsidiary company taxable because, for example, the subsidiary was acquired for the dominant purpose of disposal? One of the questions we often get asked in these scenarios, particularly with international investors into New Zealand, is there a time frame I have to be mindful of? If I hold it for more than a year or more than 5 years, does that mean I'm not going to be taxed? And the answer to that question is no. These rules have no defined time limits. So you could purchase a subsidiary company and sell it a few weeks later, and in theory that could be a non-taxable capital gain. And in contrast, you could purchase a subsidiary and sell it 20 years later, and that could still be taxable. So time is just not a relevant concept when we're looking at these rules. With that said, of course, when a tax authority looks at these circumstances, they're going to be far more sceptical with the benefit of hindsight, where we see a subsidiary entity sold in a relatively short period of time. And in those scenarios, what we're looking for is not just really good documentation, as I talked about what was the purpose of acquisition, but the ability for the vendor and the selling group to be able to point to some kind of change of circumstance. So what has led the group that's making the disposal to change their mind in respect to this subsidiary, which means while on acquisition they didn't have a purpose of selling it, they've now decided that selling it is the right thing. And I think if you can find that really compelling sort of change of circumstance, that's a really good part of your defence if Inland Revenue looks at the transaction to say, not only can we demonstrate up front we had a purpose other than disposal, we can demonstrate that that purpose lapsed for some reason, and that's what led to the change of mind, and that's what led to the disposal. Therefore, the transaction shouldn't be taxable. Of course, many scenarios, the assets or the business you're selling may not fit neatly into the subsidiary that is the obvious entity to sell, so there may be the need to move assets in or out of the company. Intergroup transactions in this scenario, they are taxable. They should take place at market value, and that does lead to potential for taxable income to arise, particularly around recovery of depreciation on depreciable assets. One of the slightly limiting factors here, though, is if the market value of an asset has gone up above its original cost, an intragroup transfer doesn't normally give the ability for you to step up the asset depreciation base above cost, with the exception you can actually go to Inland Revenue and ask for them to rule to the contrary on that position if the circumstances warrant it. And picking up the comment that James had already made, of course, if you're selling a subsidiary, then the buyer or the new owners of that subsidiary entity, they're going to inherit through that subsidiary all of the tax history of the subsidiary. So carve-outs involving subsidiaries, then expect, of course, due diligence to be carried out. And in New Zealand, we'd normally see vendors having to give reasonably comprehensive warranties and indemnities. Not all the time, but that is probably sort of the majority of transactions at least would see that as a feature. Transferring a subsidiary under new ownership, that does mean some of the tax attributes are lost. Imputation credits, which are the credits for tax paid, New Zealand tax paid, and I'll come on to the value of imputation credits slightly later. If there's if there's less than 66% common ownership between the ultimate owners of the selling group and the ultimate owners of the acquiring group, then imputation credits are lost. And similarly, slightly lower threshold if there's less than 49% common ownership between the vendor and purchaser, and this does trace back to ultimate owners, then tax losses would normally be lost. But we did have a change of rules going back to, it was backdated by the time it got enacted, to 1 April 2020. And this was actually dressed up as a COVID concessionary measure, which was rushed through. But now, if the subsidiary company has losses and there is no major change to its business, those losses can continue to be available going forward, despite the commonality of ownership threshold of 49% being breached. And when these rules were being introduced, the Revenue Authority, who were looking at how to frame them up, looked at the rules, particularly in the UK and Australia, and decided that the Australia same business test was proving a little bit difficult to navigate, so they opted to go down a route that is more closely aligned to the UK concept. So it's all about there not being a major change rather than a same or similar business, which is where the rules had started from originally. Now, if we are selling a subsidiary, then there is absolutely no ability for the purchaser to then get a step up in cost-based underlying assets. So there's no sort of nice tricks like you might see in an Australian context of being able to add companies into consolidated groups. That doesn't work here. No, it's the cost-based carries through. Because we're selling shares, there's no GST applicable on the sale of shares, and as mentioned a few times already, we have no stamp duty or other transfer taxes, including in respect of change of ownership of shares. All right, can we move to the next slide, please? Yeah. New Zealand does have a consolidated group regime. It's certainly not compulsory and it is limited, but for groups that have 100% common ownership, for income tax purposes at least, can elect to form a consolidated income tax group. In broad terms, the fiction that gives rise to is that the consolidated group of companies are treated as a single entity for pretty much most purposes, and therefore moving things around within the group or providing services within the group are ignored for tax purposes. Now, that's fine until you come to spin out a demerged co on this diagram here, in which case, while you're part of the group, you're joint and severally liable for the tax of the group. When you exit the group, then normally the exiting company continues to be joint and severally liable for all of the tax history and debt of income tax history and debt of the group. You can, though, make an election or application to Inland Revenue for Inland Revenue to grant permission that the joint and several liability is removed from the exiting company. Generally, we see Inland Revenue receptive to those applications and them being approved, but the point of making the application is Inland Revenue do then get the chance to at least turn their minds to the remaining group members and think whether or not those remaining group members do have the appropriate resources to meet any tax obligations that might be identified in the future but relate to the past. One of the traps we encounter with consolidated groups, once you start moving assets around, if you then have a company leaving the consolidated group, if assets have been moved into that company, then when the company leaves the group, there's a deemed disposal of those assets at the point of exit, which can trigger tax obligations. On the flip side, though, if you move assets out of a company leaving the consolidated group, then that's okay. The company can leave the group and there's no tax obligations arise. What that, though, gives rise to is an opportunity to think through what does that mean. New Zealand doesn't have a concept of the consolidated group being defined by a head company. It's any company in the group can be the nominated company for the consolidated group. So when we come to a carve-out scenario, we effectively get to choose whether it's the entity being carved out that is the consolidated group and the entities remaining effectively exit, or it's the entity being carved out that exits, the entities remaining, which is the more intuitive scenario, continue to be the consolidated group. So that means when we're shuffling assets around, provided the assets are only going in one direction, we can then potentially pick whether the exiting company is taking the consolidated group with it or exiting the consolidated group, depending which way those asset transfers have happened. So you also have consolidated groups for GST purposes. Slightly lower threshold here, we need 66% common ownership rather than 100% common ownership. But as for income tax, members of a consolidated GST group are joint and severally liable for GST debts of the group. That can cause some issues in demerger scenarios, with a small subsidiary being demerged, in theory being joint and severally liable for what can be very considerable GST risks from the former group it was part of, and some challenging discussions around quantums of indemnities that may be given to manage that risk for acquirers. After a bit of lobbying, governments agreed that it's appropriate for a similar process to be in place for GST as is currently in place for income tax, where an application can be made to Inland Revenue for the exiting company to have a clean exit from the consolidated group and cease to be joint and severally liable. That's in the tax bill currently before Parliament. It's very late through the process, and that bill has to be enacted by the end of March for various income tax reasons. So literally within the next week, that will be law, and we will be able to sort of start adopting this in the context of transactions. We'll move to the next slide, please. Right. So now, once we've spun out, carved off, demerged the business, typically we're going to be left with some proceeds in the group, which we'll want to return to shareholders. So we'll all of that to shareholders. So in using the starting proposition we have here is where a company transfers value to shareholders, that will be a dividend, and therefore dividends are taxable. And then we have to work through a number of exemptions or exceptions to that basic rule. One's most likely, or typically relevant in this scenario, is where the company makes a return to shareholders, and that return to shareholders results in the shareholders suffering a 15% reduction in the value of their shares, or if inland revenue agrees to a 10% reduction in the value of the shares. And that distribution of proceeds is not in lieu of a dividend. So there, for example, we're looking at dividend histories and being able to point to this being clearly an exceptional event rather than an ordinary dividend that's been dressed up as a non-taxable transaction. Then that distribution can be tax-free, but only up to the amount of capital, which in New Zealand we refer to as available subscribed capital, or ASC, that is available. And as an interesting aside there, one of the issues that's come up recently is that because ASC is a concept that dates right the way back to when the company was first formed, some companies' record keeping as to what their available subscribed capital is a little limited. So last week, Inland Revenue launched a consultation process about potentially mandating specific record keeping requirements for available subscribed capital, and if those aren't maintained, deeming the available subscribed capital to be nil. So quite a sort of harsh outcome, but reflects the fact that at the moment it's run into difficulties where records aren't available. These concepts can give rise to real issues in this world of untaxed capital gains, because if we haven't paid tax on a capital gain, we don't have imputation credits. Now, the only way we can get a capital gain out of a company tax-free is to actually liquidate the company and pass the capital gain out in the course of liquidation. So that can be quite a significant event. Some scenarios that works, particularly if someone had the foresight to structure the group as a very plain and simple holding company with a series of subsidiaries. It might be possible to liquidate the holding company and pass out the proceeds from the sale of one subsidiary and the remaining subsidiary to shareholders as a distribution of a capital gain. It can work. But if we are paying a dividend and we have got imputation credits available, then effectively we're left with imputing dividends. That's a credit for New Zealand shareholders. Tax paid by the company is 28%, credit up to the whatever the marginal rate of the shareholder is. When we're dealing with distributions those to non-residents, we need to look at what size shareholding the non-resident has. If the non-resident is a shareholder with more than 10% shareholding and we can fully impute a dividend, then that dividend can be distributed with no withholding tax. So a nice simple rule. If not imputed, then we have to turn to double tax agreements. We start at 30% and it's reduced progressively through 15 to 5 or 0%, depending on what the treaty says. For shareholders who are less than 10%, if we've got imputation credits available, we run into a peculiar supplementary dividend regime where we can effectively pay a supplementary dividend equal to the amount of 15% withholding tax, reduces the ultimate tax borne by the shareholder to nothing, so the shareholder gets a gross dividend even though they pay 15% tax. Okay, move to the last slide, please. So James talked a bit about the demerger relief that's available in Australia, and Aaron sort of highlighted a few transactions. In New Zealand, we don't have any concept of demerger relief, apart from a one-off transaction from 10 or 15 years ago. So when we're dealing with demergers, what we're looking at is ordinary rules. So if we are spinning out or distributing a demerger company to shareholders, then that is simply a dividend unless we fall into one of those exemptions I've just talked about. So is it a return of capital, or is it done when we wind up the holding company and therefore can be treated as a capital gain distributed tax-free? So that can make it quite difficult to actually distribute proceeds, untaxed proceeds in particular, to shareholders. Something that we do see a bit more, particularly in the more private company context is potentially having the shareholders of the existing company set up a new company, we'll call it in this bottom diagram here, demerge co, where then the old original group, head co in that diagram, can move the assets across to demerge co. And if there's a transfer of value in that, so particularly when we're dealing with capital assets that have appreciated in value a lot, the capital gain for the transferor company is non-taxable. The value received by the demerge co is actually a dividend. But because the dividend is from a company that's under identical ownership, that dividend is exempt. So that can allow some reasonably significant value to be transferred to a new company in an exempt, non-taxable one side, exempt transaction on the other. So it can be useful, but hard to do in a listed company context, easier to do in a privately owned company context. Okay, well that brings me to the end of my section. James, I think, are you back online?
I am. Thanks, Ian.
Yeah, we didn't do the polling question, so...
Brings us to the next question. Polling question for today is, what impact do tax considerations have on your decision of whether or not to pursue a carve-out? The options being not relevant at all, somewhat relevant, a key determinant, or don't know, not applicable. Just while we wait for the responses to come through, I think, Aaron, it's interesting to note in the Intralinks 2020 M&A report mentioned earlier, according to 30% of APAC respondents, the greatest threat to M&A activity in 2022 is rising regulatory scrutiny, followed by higher corporate tax rates at 21%. What do you see as the potential challenges ahead, or more specifically in the Australian market?
Yeah, I think the Australian market probably differs in that people are less worried about any change in regulatory scrutiny. It's more largely driven at the moment around macro events. So people obviously continuing to look very closely at what's happening in the share market more broadly, changes in interest rates, inflation, supply chain pressures. There's obviously a whole raft of issues at the moment that are making things difficult or more challenging than otherwise might be from an economic and business backdrop. So, yeah, that tends to be where the focus is here at the moment.
Those responses just coming through, which obviously shows that tax is a pretty important consideration when considering a carve-out, look particularly there at relevant and key determinant. It's quite interesting. So thanks, Aaron and Ian. That does bring us to the end of our discussion today. We do have some time for questions from our audience. I'm not sure if any have come through in the chat box at the moment, but I suppose one interesting thing that we were talking about earlier, Ian, is just around, I guess, the differing approaches between OIO and FIRB and what role Inland Revenue and the ATO have in that. So I think particularly with respect to Australia, we've seen the ATO play more of a role alongside FIRB and being more involved in the transaction approval process, and also then looking to impose tax conditions on purchases as part of that approval process, which can mean this ongoing reporting obligations. It also means a lot of the structuring work has to be front-ended as part of the application, so that the purchaser has a good idea of source of funding, terms of any intragroup debt or shareholder debt, etc. How are you seeing that play out in New Zealand currently?
Yeah, I think, as we were talking about earlier, I think it sounds like New Zealand's a little bit behind where the ATO's got to. So up until a year ago, OIO, overseas investment office applications, didn't have any reference to tax at all. It was about good standing largely of the foreign purchaser. But there's a change of rules introduced last year which now require applications to include some tax details about the structure that's going to be adopted. But under the rules at the moment, that's simply a disclosure form. So the aim is to give Inland Revenue a heads up that the transaction's about to happen and the structure that's going to be adopted for the transaction. But Inland Revenue don't have any input into the OIO decision-making process. So their forearmed in terms of understanding the structure, but can't impose, or not in a position yet where they can impose obligations into the acquisition. So really interesting to see where that goes and whether we sort of follow that trend of actually having inland revenue becoming even more involved and imposing conditions on purchasers in terms of how they structure things. I think there is a bit of a good standing question, though, is also extended to look at the tax affairs of the purchaser globally and whether they entered into any tax avoidance transactions or have significant tax penalties imposed upon them. So which is the sort of an influencing decision on the OA's decision making. But the structuring at this stage is purely a disclosure obligation.
Thanks, Ian. So that is, unfortunately, we have time for today. Aaron and Ian, thank you, and special thanks to all of you who are able to join us today. We'd like to encourage you to fill out the short survey that will pop up on your screen momentarily and tell us what you think about today's program. If you joined us late, please note that this presentation will be archived for future viewing. And if you feel that others would benefit from this webcast, please share the webcast via that share this icon or have them visit the Debrief's website. We'll also respond to any other questions that are submitted in the next couple of weeks. Also, if you do think of any other questions or comments later, please feel free to reach out either to me or to our speakers. We'd be more than happy to talk to you. And please don't forget to tune in to our next scheduled webcast from the Corporate Income Tax Series on 24 March titled M&A and Carve-Out Strategy in Japan, Korea and Taiwan. And last, from all of us at Deloitte, thank you for your participation in Deloitte's Asia Pacific Tax Webcast today. Goodbye.